Good evening, students. Welcome to the first session for the direct tax class. Yes, good evening, Vanshika. Good evening, Mansha. So, we are going to be discussing today the basic concepts. Welcome to this session. So, two lectures we have been allocated for the basic concepts. Good evening, Viraj. Yes, and we are going to have the applicability of Finance Act 2023, which is going to be very, very important for your attempt. So keeping that in mind, we are going to first discuss the basic concepts. That is going to be the first chapter. And then we are going to move towards the PGBP and capital gain for the month of October. So that's what our schedule looks like for 31st of October. So I think many of the students have already been attending the last lectures as well, which I think we had it in July. Yes, good evening, Shankarao. Good evening, Sailesh. Yes, good evening, Harita, Chitala. Good evening, Prerna. Glad to know our names are similar. And good evening, Mohammed. Yes. So basically, what we are going to now do is we are going to focus on very introductory, very basic concept. Yes, Simran, this will cover the entire syllabus of paper 4, and this is going to be the new scheme. And this, yes, good evening, Geeta. So all of those who would have, studied till now with me in the past, because I could see many familiar names which have been doing the lectures in the past also would find it more or less same, because this is something which is a very, very basic concept. So I'm expecting, therefore, since you have already attended the sessions in past, I'm expecting you to be answering the questions and being very, very participative, because that's how the lectures are being designed. It's not going to be a one-way flow. The importance would be through the practicing the questions. I think those who have attended would already be knowing that how we practice so many questions of each of the chapter. I try to give you the questions which have the maximum possible adjustments, so that you don't need to go through several questions, but you can have like a one comprehensive question covering all the adjustments together. So that is what the scheme basically looks like. And by that means your examination practice would keep on happening. Also, students, it's very important to practice, because not only for direct tax paper, I would request you for all your papers, be it a theory paper or a practical paper, the practice is the key. You cannot play a World Cup without the test matches. Remember that. So you have to practice always enough. You have to be on your toes. You have to solve as many mock exams as possible. You have to go through past exam questions, so that you are able to have that kind of grip on each subject. Because this is the CA final level, right? And you are expected to have that kind of presentation of your answers as well. So unless and until you practice properly, also, most of the students have habit to do the practice in the rough papers, and, would just, do plus minus or the practice on the calculator. Never. You don't have to do that way. Practice means like the way you would write for examination. Of course, I understand that time is always short with you. You have like so many papers to study, so many subjects you have. So you cannot, do like an entire presentation as you would produce an exam. But at least for as many questions as you can, you should try to do that kind of practice. Of course, for the rest of them, which are easy questions, which could be solved quickly, at least you should make the presentation in a manner that you should be, or you would be doing, if not in the examination, but at least you should be doing that kind of presentation, which is just not like a rough presentation. You have to put in that much efforts. Now, coming to the direct tax paper, as I said, this is like a module in itself, right? So, or, it covers the huge syllabus. So, how do we remember the sections? How do we remember the case laws? Because there's so much. So, as I said, direct tax paper is something, as well as the indirect tax paper is something which you should keep on revising at least every weekly basis. So some students may be having the habit of taking like one subject for the entire week and then moving on to the another subject. But these papers, you should be at least spending, like 10 to 15 minutes a week to revise what you would have studied in the last week. Or if not 10 to 15 minutes, you can spend at least like a maybe 1 hour, 2 hour to just recap and not lose the touch of it. Because these papers require you to have that kind of engagement with the subject on day-to-day basis. Same goes with even the law, because these have like so many sections, so many penalties, and you need to remember it. So also what happens is when you are kind of studying, you try to escape that, okay, let's just read the fundamentals and let's just not remember the section. You have that kind of tendency to do that, but do not do that. When you are studying from day one, from these lectures, from the introductory lectures onwards, try to make the habit of reading with the section number. 24, okay, house property deduction. 32, depreciation. So you have to keep on saying the sections along with the content so that these sections automatically get registered. Of course, even I may not remember like the entire sections which are there. Like there are so many penalty sections, there are so many other sections, prosecution sections. So you may not remember those, but at least the important ones you should be knowing and remembering it by heart. And that will only happen when you are studying and doing it on the day-to-day basis. And when you are reading, when you are revising with the section numbers itself and not on an isolated basis. If you just make a list of section number and then try to read it or remember it, it is not going to happen. Also, secondly, there is always a logic, there is always a reasoning, there is always an understanding behind the section. Try to take a hold of that. Try to understand the basics of the direct tax. Once you have the grip of the basics, the complex questions will also be very much doable because you have understood the basics itself, right? So you have to keep a hold of the basics always. And as I said, the practical problems you have to solve as much as you can. Because for the direct tax paper, the presentation, even not only for direct tax, but even for other papers, the presentation is going to be key. So how do you write will also be determinative of your markings. It's not that you only put, okay, say depreciation is allowed on this or not, or this much is the rate of depreciation. It's not about that. How you present your answers is also going to be very important, because remember, you are going to be a chartered accountant once you pass these examinations. So focus on the presentation, and that is what even the focus would be for these classes. So do not miss it. Be very, very participative as much as you can. Yes, Prerna, as I said, this will cover the entire syllabus for May 24, and the focus will be on Finance Act 2023 as well as the amendments which are applicable till 30th of September. Right? Yes, good evening, Ravish. The soft copy will be available. So, Vanshika, I'm not going to give you any notes. The basis of our lecture is going to be module. You're required to study the module. Do not rely on any notes. You have to study through the module. Notes are going to be the shortcut. So that there's no shortcut to success. You have to read the module. Before every lecture, make it a point that you come and read the module. Now, this is going to be the first class, but now onwards, I'm telling you, you have to read the module and come here so that you can ask me the doubts rather than, you going back and studying module. Instead of that, I would suggest you to read and sit here so that you would have the better understanding. Secondly, the notes will be given to you, but these are going to be the running notes. So a point to you for the direct tax lecture is that please maintain a separate notebook. It is going to be required. Now, this notebook will be a revision notebook, because what we are going to here do is we are going to cover all the concepts over here. I'm going to make a lot of charts for you so that you can revise one day before your examination easily, and also when you are sitting for the recapping the entire paper. So this notebook, you are going to make it. You have to write the notes as and when I am writing it on the screen. Try to have 2-3 different color pens. Usually you can have like a blue, red, green color pen, so that we make it a point that whatever is going to be important, you write it with red. So that when you are revising, you see that. Use the highlighters to highlight those points which are going to be very, very, very important, or which are to be worth captured in your mind so that it gets registered, right? So blue is something which will be the normal notes which is going to be there, right? But the red is something which is, you have to keep it as like very important. So you can keep two color pens and the highlighters basically to highlight the points that I'm giving, which I'm also highlighting on screen. At least I used to do for my examination in this particular manner. I used to make my notebook. In the notebook, I used to just highlight whatever I used to feel important so that I don't have to read everything again and again. Same thing, you can do it in your module as well when you are having the prints of that. Secondly, whatever I would make a mistake in some questions, or whatever I feel that this is important, I would write it in bold letters in red and highlight that. So that when I write the exam, I have that in the back of my mind that, okay, this was written in red. I don't have to repeat that mistake. Are we clear? So is this clear? The fundamentals for the lectures, are we clear about it? Yes, good evening, Ravish. Good evening, Jyoti. May 24, Vanshika, yes, it is going to be applicable. So November 25, you will have to then again watch the revised lectures for that attempt, which will happen only in the next year, Vanshika. But yes, as of now, you can always watch it because the concepts of the direct tax will remain the same forever. It's only that the amendments will keep on happening. Okay? All of you are clear. You have to maintain a notebook with the color pens and the highlighters. And the third rule is, so one rule, notebook. Second is your pens and highlighters. And the third is read the module before the lecture. And before you sleep, so we are going to finish off our classes at 9 p.m. So before you sleep, you will revise what we did in today's class and in the every subsequent class that we do. So 4 rules, we have to keep it in mind. Clear? So after we finish off our lecture, before you go to sleep, just for the 15 minutes, recap what we have done. That will help you for your next lecture as well. Okay? But we will also do recap. At least I used to do when I was studying for my CA final. What I always used to do is, before I close the subject for the day, I will just revise whatever I've studied so that there's a quick recap. Before I begin the subject next day, I will again give a recap to myself to bring that link for the next day. Yes, perfect. Okay, let's get quickly started then. We have already spent 15 minutes for understanding the fundamentals. Now let's understand the fundamentals of the Income Tax Act. Okay, now tell me, what is the difference between income tax versus the GST or any other indirect tax that you observe? So let's first focus on income tax versus GST. What is the difference? You have two modules, direct and indirect tax. So what is the difference between a direct tax? Why income tax is direct tax and GST is an indirect tax? Or for that matter, your customs law. Yes, what is the difference? Back to IPCC. We have been studying two subjects, direct, indirect tax since IPCC. What is the difference that we see? Yes. Everybody has to be participated. That's rule number 5, okay? Because that will, even if your answers are wrong, but having the answers wrong is very, very important because at least you will not get that wrong in examination. Getting it wrong here will help you remembering that, okay, I answered this wrong and therefore I will not repeat this mistake in the exam. So whatever you are saying wrong, if it is going wrong, write that down on your notebook. Put it in the red pen, wrong, and write it at the top. This was wrong and this is right. Okay. Yes, Jyoti, direct tax is a progressive tax, whereas Mansha is saying indirect tax is regressive. Yes, that's correct. So what do we, I mean, you're not familiar with what is progressive, what is regressive, can you help me with that? This seems little, theory. What is a progressive? What is regressive? Mansha, Jyoti. Yes, Prerna, correct. Direct tax is on personal income and property. Okay, any tax on property that you know, Prerna? GST is borne by ultimate user, but income tax is borne by person earning the income. Yes, Harita, very good. DT is charged on person directly on his or her income. Yes, Ravish, correct. Shankar Rao, direct tax is incidence and impact lies on same person, and indirect tax incidence and impact lies on different person. Yeah, Shankara, that's correct. No effect on higher income in GST. Mithalia, yes, you're correct in a way, yes. Jyoti, yes, direct tax is levied on person based on his income. Yes, correct. Geeta, in income we pay tax on income we earn. In indirect tax we pay on goods and services we sell and purchase. Yes, a very valid point, Geeta. Direct tax is an income of individual, whereas indirect tax is goods and service. Yes, Mohammed, correct. Vinay is saying direct tax again incidence on same and indirect tax is incidence on different person. Correct. Chitala, income taxes are levied on income and profits, but GST is on goods and services. Yes. Harita, progressive means higher income, higher tax. That's correct. Yes. Mithalia, DT is on income, IDT is on supply. Yes. Jyoti is saying direct is progressive. That is, it is directly proportional on the income, whereas indirect tax is regressive and it is charged irrespective of income. Very perfect, Jyoti. Yes. All of your answers are absolutely correct. Now, remember one thing. All of you have said very correct that direct tax is the tax on the person directly. Indirect taxes, the tax where the incidence and the impact of the tax can be shifted on the final consumer, right? So, income tax is the classic example of direct tax, wherein we have the taxes on the income earned by me. I cannot shift the burden. Whereas in indirect tax, it is on supply of goods or services under GST or under the custom law, and therefore the impact I can shift it on the final consumer. Yes. Yes, Geeta, in income tax, there is no input credit available, whereas under the indirect tax, it is indirect tax credit is input tax credit is available. And Shankara, direct tax, the person earning the income will pay the tax and the person buying the goods and services in the indirect tax will be different. Yeah, that's correct. So, under the direct and indirect tax, also remember one very important thing. So, one important thing over here is that you have to ask question under the indirect taxes that where the goods and the services are being sold or consumed. So the indirect tax which is there is a destination-based consumption tax, isn't it? Just write it down over here. So under the indirect tax, so I'm following the first rule, which is the black and so the blue pen and the red pen that we have. So direct taxes and indirect taxes. Here you need to ask the question that where the goods or the services are consumed, because this is the destination based consumption tax, right? This is a destination based consumption tax. So here what question we need to ask is that where the goods or the services are consumed. Okay, let me just zoom the screen. If you are not able to see it, let me just here. Is it fine now for everyone? Second. Okay, fine. So, under direct tax, as I said, here we have the income which is getting taxed, right? So here we have the taxability on the income, right? The taxability is on the income. Whereas under the indirect tax, the taxability which is there is on the supply of the goods or services, right? So under the indirect tax, the taxability is on supply of goods or services. So if you see here, the question which assumes importance is that where the goods or services are being consumed. Where the goods or services are being consumed. Whereas under income tax, the question that we need to ask is, who is earning the income? Who is earning the income? So here, since the direct tax is on the person who is earning the income, it is a direct tax in nature. So here, since the burden is on person who is earning the income, the question that we need to ask is, who is earning the income? Whereas in the indirect tax, the burden is shifted to the final consumer. Burden is shifted to the final consumer. So the question that we need to ask is where the goods or services are consumed, because this is a destination based consumption tax. And that is why if you look at it, the exports are always zero rated, whereas the imports have the custom duty. Now, did you understand the logic? Why the imports have the custom duty and exports are zero rated? Because you cannot export the duty. Because where the goods or services are being consumed, the goods or services are being consumed in the other country where you're making the exports. So the taxes would be levied in that particular country. And that is why you need to ask the question where the goods or services are being consumed. Whereas under the income tax is on the person who is earning the income, and therefore you need to ask who is earning the income. Are we clear? And secondly, as we said, that the difference is that this is a progressive. That is, it is on the higher the income, higher will be the tax. Whereas this is always a flat rate of tax. So this is a regressive tax in nature. Right? So these are the majorly difference. Now, let's get back to the basic, the fundamental of the tax or fundamental of any particular law. These are the tax laws, right? These are at the end the laws. There is a code, there is a statute in place. Now, any statute that is formed gets the authority through the constitution. Whenever you are looking at any law, the fundamentals of that laws are derived through the constitution. Now, how do we bring a particular law in place? That cannot be without the authority in the constitution. So the Constitution of India in Article 265 of the Indian Constitution provides that the no tax shall be collected or levied or collected except by the authority of law. Right? So therefore, any tax which is levied has to be through a legal statute in place. So Constitution of India gives the power to the Parliament to collect or to levy the taxes, whether direct or whether indirect. The power has been given to even the state legislature where the state taxes are levied. Let's say, for example, property tax, municipal taxes that are levied by the state legislature, right? That are levied by the state legislature, and therefore any tax which is there can be collected by either parliament or state legislature only through a proper legal code. Now, how does the parliament get the power to levy income tax? There are three lists that all of us know. Union list, which is list 1. List 2 is the state list, where the state legislature has the power. And then there is a concurrent list where both the parliament and state legislature have the power. So, under the list 1 of 7 scheduled to Article 246 of the Constitution. So, under the list 1, there is an entry number 82, which is the income tax. So, the Parliament has the power to levy and collect the income tax. Are we clear? So, entry 82 of list 1. To 7th schedule, right, gives the power to the Parliament. This consists of income tax. Are we clear? Now, coming back to the income tax law. This is just, very basic that information that I gave you, which I think most of us would be knowing. Is it still not visible? Let me do something. I think it should be visible. Now is it visible? Yes, is it visible now? I have made Zoom also. Okay, yes. So now let's get back to the income tax. What is the name of the act? Income Tax Act 1961. Now, when you are talking about Income Tax Act, or when we are, doing the interpretation of the Income Tax Act, it's not just that we have to look at the Income Tax Act. There is Income Tax Act. Then the amendments to the Income Tax Act are carried out annually through the Finance Act. So annually, the amendments to the Income Tax Act are carried out through the Finance Act. The budget that you see on 1st of February gets passed in Lok Sabha, Rajya Sabha, and then the President assent, and then it becomes the Finance Act. So the Union Budget eventually becomes the Finance Act. Then we have Income Tax Rules. Then we have Income Tax Rules. What is the purpose of Income Tax Rules? Yes. What is the purpose of the Income Tax Rules? Income Tax Rules 1962. Yes, can anybody tell me what is the purpose of Income Tax Rule? You have to be very clear with the basics because see, you are going to be a chartered accountant. You cannot then ask the question, what is the purpose of income tax rule? This is the point where you will study about small details. Later, when you become a CA, you need to have these answers rather than asking the questions. Jyoti, yes, to make necessary changes. No, that's not the correct purpose. Vinay, to administrate. Yes. Can you give me an example? What to administrate? You're correct, Vinay, but can you give me an example? Mithila, respective amendments in respective rules? No. What are the income tax rules? Yes, students, we have been now in CA final. You have done IPCC. What is income tax rule? Example, depreciation? No. Vinay? No. Depreciation, the rates comes to the rules, but I'm saying like what is the purpose? Allowed and disallowed expense in PGBP? No, Vinay. To provide changes to different rates? No, Vanshika. The changes to the rates come through Finance Act. Remember that. The Act will always provide you the rates. The Act is providing you the special tax rates. The general tax rates are coming through the Finance Act. That we are going to discuss. Prerna, understanding of Act sections? No, that's not the purpose of the rules, Prerna. Rules for how to comply with section in Income Tax Act. Yes, Viraj, very good. Vinay, the rates, as I said, will come through either the Income Tax Act or to Finance Act. Ravish, yes, to facilitate the functioning of the provisions of Act. That you're right. But can you give one example? Because look, we don't need to give the theory answers. We need to also understand how practically it happens. Okay. Jyoti, to provide guidance for implementation of Act. No, it doesn't provide any guidance. Salish, compliance related rule. Yes, very good, Salish. Compliance related rules. Shankara, rules prescribe the procedures. Yes, very good, Shankara. Vinay, yes. Very good examples for valuation, for limits. Yes. Harita, yes. Very, very, very nice answer. Very nice. Even I would have not put it so clearly how Harita has put it. She says, Act says what to do and rule says how to do. So Harita, I'm borrowing your sentence which you have put up here, which is very precise, that the Act will give you what to do and the rules will tell you how to do. So that's precisely what the income tax rules will do. Let's take an example. Section 139. See, I'm now onwards from the basic concept class, I'm starting to use the section number so that this gets registered in your mind. This is how you should be also reading and revising it. Section 139 of the Income Tax Act. I would have even said it like return filing section. No, but I have to read it like this way only. Section 139 of the Income Tax Act, which talks about filing the return of income. Right? All of you in your articleship would have filed the returns of income. Right? From where does it? This requirement comes in section 139. 139 says that you need to file your return of income. Correct? Now, it just says that you are required to file the return of income. So-and-so person having so-and-so income or so-and-so person is required to file the return of income. But which form to file? ITR 1, ITR 2, ITR 3, 7, what? Which form to file? Where does that come from? In articleship, you would have filed so many return of income. And finding out through your softwares, okay, ITR 1 software is saying ITR 1, we'll file ITR 1. But did you go and see where does this requirement comes in? Which ITR to file? Does 139 says that? The answer is no. 139 just says that an individual having the income more than the basic exemption limit or more than the maximum amount chargeable to tax is required to file the return of income. Now, which return of income, which form? That is taken care by the rule. So, rules will provide the workability to the section. Rules are essentially being notified, mark my language, rules are notified to make the provisions of the act workable. Now 139, if it just says file return of income, how would I file? I don't know how to file. I have to e-file, attach DSC, do the e-verification. E-verification also there are 3-4 methods, bank, net banking, Aadhaar, OTP. Where is it given? Everything has to come through the law. It's not that income tax department is doing anything on its own. No. So basically, income tax rules are requiring that. And we go to the income tax rules to find out that. Are we getting that? So yes, Mithalaya, rules help in governing the law. Are we getting that? So this way we have so many rules for the Income Tax Act to make the provisions of the Act workable. And as Harita rightly said, Act will tell you what to do and the rules will tell you how to do. Now the best way to find out or to read the Act, you have to open the bare Act. I'm just showing you a glimpse of the Income Tax Department website which is there, which consists of the Income Tax Act. They have revamped the website last month itself. And if you look at it, for every section, you would find related rules and content. For every section, you would find related rules and content. Let's say, for example, I was discussing about section 139. I'll put here the section number and it says show related rules. See, these are the rules which I was talking about. And you will get to know where exactly what is being said. So as I was telling you, the income tax forms which are there, which forms we need to file. So for that purpose, you need to go to these income tax rules. So let's say rule 12. This will give me ITR 1, ITR 2, ITR 3, digital signature, EDC, all of that. So articleship, you have done a lot of return filing, but this is where the logic is coming through. This is where the provisions are being written up. Are we clear? Yes? Okay. So basically, we have several income tax rules in place for each of these sections. So that is the purpose of the income tax rules. So we have separate rules in place for each of these sections. Let's say, for example, you have HRA. Now, how the limit of the HRA, you would have studied in your IPCC, 40% for non-metro, 50% for metro cities. There's this formula which is coming in for leave encashment, for gratuity exemption. Where does it come from? So these limits are coming through the income tax rules. Those limits are coming through the income tax rules. So income tax tells you that, okay, there are certain allowances which would be exempt as may be prescribed. Wherever the word used is as may be prescribed, you need to go to the rules to find out what the rules prescribe. Are we getting that? Or there are certain exemptions which are based on conditions. There are certain particular provisions where the approvals are required. How to obtain those approvals? What are the conditions for approvals? Under section 10, there are certain approvals. How do we get the valuation done? Under section 56 to 10, under section 56 to 10, if you receive any asset for inadequate or adequate for without any consideration, that is considered as the income of the recipient, isn't it? Now, how do you value that asset? The valuation will be taken care by the rules. When the employee receives the perquisites, how do we value those perquisites? That is taken care by the rules, isn't it? What is the audit report format which is to be furnished in 3CD, in 3CEB? What are the prescribed authorities for allowing certain exemptions? That is taken care by the rules. So basically, rules are governing the workability of the section. Are we clear about the rules? Now, who frames the rules? Whether the parliament frames the rules? Oh, the screen is not visible. One second. Whether the parliament frames the rules? Who frames the rules? How the rules are introduced in the income tax rules? Yes. Yes. Who introduces the rules? CBDT. Yes. Central Board of Direct Taxes. CBDT is the one which introduces the rules. CBDT is one which introduces the rules, basically. The parliament is not introducing the rules. Why? But the income tax is mentioned in list 1. So why CBDT? Why CBDT has the power? How CBDT has the power? Can you tell me how the CBDT gets the power? Why not the parliament? So the act is legislated by the parliament. So then how the CBDT is having the power? Yes? Tell me. Finance Ministry on recommendations of CBDT? No. These are some basic questions that I'm asking you. How the CBDT gets the power? Yes. Through Ministry of Finance. Yes. So through Ministry of Finance, there is Parliament has the power to legislate yet. But there's this delegated power because the income tax says that as may be prescribed. So prescribed has to be given by the CBDT. Now the CBDT is functioning under the Ministry of Finance. The CBDT is functioning through the Ministry of Finance in the Department of Revenue. So CBDT is a statutory body which is constituted under the Central Board of Revenue Act. It functions under the Ministry of Finance, Department of Revenue. And CBDT frames the rules because the CBDT has been authorized to frame the rules through the Income Tax Act itself. So the authority has been given to the CBDT to frame the rules basically. So which section authorizes the CBDT to frame the rules? The power to make rules is coming through the section 295. Section 295. Yes, Geeta, you are correct. The Parliament has appointed CBDT, but how does that appointment has been done? It is not done through the outside of Act. It is done through the Act. So the board, I'll just show you that particular section. Let's just have a look at it. The board may, subject to the control of central government, by notification in the Gazette of India, make rules for the whole or any part of India for carrying out the purposes of this Act. Are we getting that? So through section 245, 295, the CBDT has been authorized to make the rules, to notify the rules basically. The board means what? The Central Board of Direct Taxes. Now you will say, ma'am, where is it written that board means Central Board of Direct Taxes? So the board, in fact, here, if we look at the definition of board under the section 2 of the Income Tax Act. So board is defined to mean the Central Board of Direct Taxes. So instead of they using the term board again and again, they are using the term board. I'll show you under section 2 if you go the definitions. Let's have a look at it. Board means Central Board of Direct Taxes. So basically section 295 is giving the power to CBDT. The act itself is authorizing CBDT. Unless and until that authority is there, CBDT cannot notify any rules. And one of the classic judgment which strikes down the CBDT's notification was in the case of Chamber of Tax Consultants, Delhi High Court, which was in the context of ICDS notified by the CBDT without any legislative presence, without any legislative authority. So the CBDT went ahead and notified ICDS, Income Computation and Disclosure Standards, without having the authority of the law. No part, no section of the Income Tax Act provided that the CBDT can prescribe the ICDS. The CBDT went ahead and prescribed the ICDS through a notification, through the rules, and that was struck down by the Delhi High Court as extrajudicial power. Are we clear? So the power comes through the Income Tax Act. We are clear till now? Yes or no? Okay. Now then comes the circulars and the notification. What is the difference between circular and notification, or what are their respective purposes? What do we understand by circulars, notifications? Yes. What do we understand by circulars, notifications? Yes, fast. Yes, students. Yes, you are correct. Mithalia, income tax was introduced by James Wilson in India. Yes. So circulars are meant for department staff, notification meant for all, no rubbish. For specific problems, circular issued to clarify, yes, Geeta, correct. To add quick changes, no Vinay. Circular is for internal, no Chitala. Harita, circular solution for problem and notification, new provisions, yes, correct. Ma'am, 10 sec. Okay, yeah, got it, Vinay. Okay, so circulars which are issued are basically, yes, Viraj, for clarification of section. So if there is any ambiguity in the section, so circulars basically assist in understand the section. Like let's say the recent circular was on 194R, 194S TDS provision, wherein there was TDS provision introduced on perquisites. Now to understand that, because that was very complex provision, so to understand that, the circulars were issued. So basically circulars are for clarification of section. And circulars are binding on the department and not on the assessee. So circulars are binding on the department and not on the assessee. Remember that. So basically the circulars are issued by the CBDT to clarify the ambiguity under the provisions of the Act. They are also issued internal circulars which are issued for the department. The department is bound by the circulars, whereas the assessees are not bound by it. The assessee can obviously take the advantage of the beneficial circular. So this is to clarify the Act, or let's say the provisions of the Act. This is to clarify the provisions of the Act. This is binding on the department and assessee is not bound by the same. Fine. What do we understand then by the notifications? So notifications are also issued by the either the CBDT or by the central government. Mostly the notifications are issued by the central government. So basically the circulars you can write to clarify the provisions of the Act, and this is issued always by the CBDT. Right? And the notifications which are issued, these are issued by the central government usually. Sometimes by CBDT, but mostly by the central government. Because if it is by the CBDT, the Act will specifically provide by it. Even in the case of central government, the Act will provide for it, that as may be notified by the central government. Now, the notification which is issued is specifically for purpose of notifying certain things. Like let's say, for example, the rules are notified. So rules are issued through the notification by the, again, CBDT. Similarly, the Act may provide for that. Let's say, for example, a certain provision is there, and let's say ATG. So the trust which are there, which are covered under ATG, 50% deduction, which may be notified by the central government in the official gazette. So the notification will be achieved by the notification will be made basically by the central government. As I said, the CBDT can also notify. Let's say, for example, the CBDT has power to lay down the rules. So the rules can be notified by the CBDT in the official gazette. Okay. So the notifications are basically to notify the provisions of the Act which are specifically laid down under the Act, that this will be provided through a notification. So notification is basically to notify something. So that is how you will read the income tax law. Income Tax Act, Finance Act, income tax rules, circulars, and then the notification. Now, what is applicable for your exam is till 30th September, whatever the circulars and notifications are issued, the Finance Act 2023, that will be applicable for your examination. Are we clear? Secondly, we also have the case laws. Now, what are the judgments? The judgments are either by the ICAI, by the High Court, and then by the Supreme Court. So ICAI is the final fact-finding authority. Then we have the question of law goes before the High Court and Supreme Court. For CA final level, the ICAI judgments are not applicable. The Supreme Court and High Court judgments are applicable. Again, that ones which are issued till 30th September, those judgments will only be applicable for your attempt. So basically, the role of the judiciary is to interpret the law. The role of the parliament is to legislate the law. The role of the CBDT is to administer the law. And the role of the judiciary is to interpret the law, how the understanding of the law should be. So that is taken care by the judicial decisions, and therefore the judicial decisions play a very important role while interpreting the income tax law. Are we clear till now? Yes or no? Yes, students? Fast? Is this clear? Basics of the Income Tax Act that we have understood? Okay? Yes? Okay. Now, let's start with the Income Tax Law, Income Tax Act basically. And let's start with it. So, I'm taking you back again to the Income Tax website where we have the Income Tax Act. Because, this will help you understand it practically as well. So, I'm just doing that for you. Okay. So section 1 which is there, what does it say? Short title, extent and commencement. Always section 1 of any law you will find will be like that. Short title is basically mean there's always a long title and a short title. The long title is the Income Tax Act 1961. That is your long title. The Income Tax Act 1961. And how it may be called. So, like your name, which is there, your full name and your nickname. Similarly, we have a long title and a short title. Now, this is called as Income Tax Act. Same way, you may prefer to, be called by your full name only. So, the short title and the long title is same. The extent of the act, what is the limit? What is the territorial limit? That is very, very important. We cannot have extraterritorial laws. We can only have the Constitution of India does not allow the extraterritorial laws. There is an exception to that, of course, when the extraterritorial law can be allowed is only when it has some nexus with India. The application of that law has some nexus with India. Other than that, the extraterritorial law is not allowed. So therefore, the extent of the law has to be provided for that to what territorial limits the law will extend. And this says it extends to the whole of India. It means even to the state of Jammu and Kashmir as well. So it will also include the territorial waters of the India, the exclusive economic zone area, which is up to the 200 nautical miles, and the territorial waters of India, which is 12 nautical miles. So this extends to whole of India, and whole of India will include the territorial waters and exclusive economic zone. And this act will come into force from the first day of April 1962, because this was applicable from 1960. This was introduced from 1961, so this will be applicable from first day of April 1962. So chapter 1 is there. The Income Tax Act is divided into several chapters. So if you look at it, you can have a look at the chapter-wise provisions also. There are several chapters of the Income Tax Act under which we have the section. Chapter 1 is preliminary, in which we have section 1, section 2 and section 3. So section 1 is the always in every law it is going to be short title, extent and commencement. Section 2 is definitions, whatever the definitions are there. Now definitions can be defined in the particular section also by way of an explanation, by the section itself, and there could be these separate general definitions which are provided in section 2. Again, in every law, you will see the definitions are always provided in section 2. The definitions can be inclusive, the definitions can be the comprehensive definitions also. Like the inclusive ones will include everything, and the ones which are comprehensive in itself, which are not expansive definition, which will always have the means part, right? And then the previous year is defined in section 3. So that is the preliminary portion. Chapter 2 is going to be the basis of charge, which is section 4 to section 9. The basis of charge is provided in section 4 to section 9. Now 4 is the charging section of the Income Tax Act. 5 is the scope of total income, and 6 is the residential status. And then 7 is income deemed to receive, 8 is dividend income, 9 is income deemed to accrue or arise in India, and there are several other connecting sections to section 9. But chapter 2 is the basis of charge. Now we are going to talk about first section 4 of the Income Tax Act. Right? We are going to talk about first section 4 of the Income Tax Act. Let's have a look at it. What does it say? Where any central act enacts that income tax shall be charged for any assessment year at any rate or rates, income tax at that rate or those rates shall be charged for that year in accordance with and subject to the provisions, including the provisions for the levy of additional income tax of this act in respect of the total income of the previous year of every person, provided that where by virtue of any provision of this act, income tax is charged in respect of income of period other than previous year, income tax shall be charged accordingly. In respect of income chargeable under subsection 1, income tax shall be deducted at source or paid in advance where it is so deductible or payable under any provisions of this act. I didn't understand anything. Can you help me with it, students? I'll just copy it so that we can break it in our notes. This is always going to be the charging section is always very important because the charge is created always through the charging section. Right? I'm just enhancing it. Okay. Yes, students. Now you have to break it down for me, or I'll at least I'm zooming in. Okay. You have to read it and try to understand. Read for 1 or 2 minutes and let's see if you can, find out some simple way for me to understand this. Yes. Okay, let's try and break it. Okay, good attempt, Vanshika. Let's see. So what does this say? Where any central act enacts that. What do we understand by central act? Finance Act. Central Act means the Finance Act, which enacts that income tax shall be charged for any assessment year. Remember, under the income tax law, we have a concept of previous year and assessment year, which all of you are knowing through your entire journey of IPCC as well. So, where the Finance Act is enacting, is legislating that the income tax shall be charged for any assessment year at any rate or rates. So, the Finance Act, as I told you, will legislate as to which particular rate will be applicable for which particular year. So the Central Act is basically either a Finance Act or your Income Tax Act itself, which is enacting that the income tax shall be charged for any assessment year at any rate or rates. Then income tax will be at that rate for that year in accordance with and subject to the provisions of the Act. In accordance with and subject to the provision of Act. So the income tax rates which will be coming through will be either through the Finance Act or the Income Tax Act itself. But how the income will be computed, how the income will be charged, how the tax rates will be charged on the income, the rates shall be charged for that year in accordance with and subject to the provisions of the Act. So what does it say? It says that in accordance with and subject to the provisions of the Act. So the income has to be computed in respect of income has to be computed in accordance with these Act. And what does it say? In respect of the rates shall be charged in respect of the rates shall be charged in respect of the total income of the previous year. So when the rates will be charged in the assessment year. Because if you look at it, what does it say? It says that if the Finance Act enacts for any assessment year, so the tax computation will happen in the assessment year, but the total income will be of the previous year. And total income of whom? As I said, every person. So the question that we asked when we started the class, who is earning the income? So here, what does it say? The total income of the previous year of every person. Total income of the previous year of every person. Then what does it say? It says that the income tax is to be charged in respect of the income accordingly. Right? So basically, what we have to see here is, sorry, let me just zoom in a little bit more here. So what we have to see here, the total income into the tax rate. Total income of the person, total income of whom? Of the person into the tax rate will give you the charging section. And the proviso is just saying that in case the income tax is to be charged on the income of other than previous year, because there are certain exceptions that if the income is not earned in the previous year, there's some prior income which is coming in, then in that case, the income tax shall be charged accordingly, because it should not happen that then the assessee may say that this income I did not earn in the previous year at all. Let's say, for example, there was some cash disallowances in the last year. or there was certain expenditure which was claimed in the last year. Now the payment for which you are making in cash in the current year more than 20,000. So then that expenditure will get disallowed, even though the expenditure was incurred in the last year and claimed as deduction in the last year. But 40A3A says that if you make the payment of the expenditure during the current year and the payment is more than 20,000 in cash, then the expenditure will be disallowed to you in this particular year. So though the income or the expense was of earlier previous year, but it will get disallowed in this previous year, right? Or there are certain instances where the income may not be of the current year, it may be of some past year, like undisclosed income, but it may be added in this particular year itself when it is discovered, right? So it is just saying that it should not be happening, that only the income of the previous year, if the exceptional circumstances provide of other than the previous year, then the income tax can be charged on that also. And then finally, it's saying that the income tax can be collected through TDS or advance tax as well. But the main point of the charging section is that the total income of person into the tax rate will be charged to tax in the, this is of the previous year, and this will be charged to tax in assessment year. Previous year, as we saw, was defined in section 3. Just now I showed you. The previous year was defined in section 3. And how is what it was defined previous year means the financial year, basically immediately preceding the assessment year. However, in case where the business or profession is newly set up or a new source of income is coming into existence, then the previous year will not begin from 1st April, but it will begin from the date of setting up of the business or profession, or when the new source of income is coming into existence, and will end till the end of the financial year. So that's what section 3 says. Assessment year is again defined in section 2 itself. And the assessment year means what? The 12 months after the 1st April or commencing on the 1st April. Right? Now, what is the meaning of total income? What do we understand by the term total income? Total income is defined under section 245. Total income is defined under section 245 of the Act to mean that defines the total income as total income means the total amount of income. Total amount of income referred to in section 5 and computed in the manner laid down in this Act. Computed in manner laid down under this Act. But total income of whom? Of the person. The person is defined under section 231. The person is defined under section 231. Person includes whom? Individual, HUF, company, firm, AOP, BOI, local authority, artificial juridical person, right? So, individual, HUF, AOP, BOI, firm, and company, right? Local authority, and artificial juridical person. Now coming back again to 245, it says total amount of income. the income is again defined. The income is again defined under section 224. Look at it how I am using the sections. You have to read it in the same manner. Section 4, charging section. It says total income of the previous year shall be charged to tax at the tax rate for the assessment year. Total income 245. What does it say? Total amount of income. Income defined under 224 in an inclusive manner. Income is defined in an inclusive manner, right? Referred to in section 5. What is section 5? The scope of total income. Section 5 is scope of total income. What is the scope of total income? That for ROR, your global income is taxable. For RNOR, only the Indian sourced income is taxable plus the income from the business or profession outside India if the business or profession is controlled or set up in India. For NR, only the Indian sourced income is taxable or if the income is received in India. So the scope of total income is dependent on the residential status, which is defined in section 6. The scope of total income is very important because unless you have the scope, unless, let's say, for example, if I'm a non-resident, my global income cannot be taxed here in India, isn't it? Can it be? No, because that is not falling in the scope of my total income. So the scope of the total income is very important. That's why it says that the scope of the income, the total amount of income as referred to in section 5. What is the scope of your total income? You have to first identify that depending on your residential status. Computed in manner laid down under this act. Now the manner laid down under this act, meaning what? The heads of income. So for every head, there is a different computation mechanism. For salaries, you have a different computation. For PGBP, you have different computation. From income from house property, you have different computation mechanism. Isn't it? So your scope of total income, which is going to be there, is dependent on that. Is going to be dependent on that, right? So you have to decide that what is the scope of your total income. Are we getting that? Okay. So heads of income and what the exact computation will say. So computed in the manner laid down under this act. So if you look at section 40, it talks about heads of income. You have salary, then you have IFHP, you have PGBP, capital gains, and income from other sources. So this is going to be 15 to section 21 or 15 to 17, sorry, my bad. Right? You have section 15 to section 17, which is your salaries. Isn't it? Then you have for the computation of total income 22 to 24, which is the income from house property. In between 18, 19, 20, 21 are omitted. PGBP is 28, oh sorry, this is still 27, deemed owner, 28 to 44. This is 45 to 55. This is 56 to 58. Then you have, of course, clubbing, chapter 6 deductions, set off of losses, right? So you have till 80, 90 section, whatever, then the tax relief claim from income outside India, all of that will come in. So that's how the computation is given under the Act. And then we have the machinery provision. So first we have the computation provision and then we have machinery provision. So if you look at it, we have machinery provision under 139 onwards, which talks about obtaining PAN, obtaining Aadhaar, income tax return filing, then income tax authorities, then appeal, revision, all of that, right? So that's how the total income of a person needs to get computed. Are we getting that? Now we are coming towards the tax rate. Now there are two tax rates which are there. One are the general rates and again then the second one is the special rates. The special rates are given under the Income Tax Act itself. You have 111A, 112, 112A, right? 115, all of those. There are special rates which are given under the Act itself for long-term, short-term capital gains, non-residents. Then you have optional scheme of taxes for the companies. That rates are given under the Act itself. And the general rates come through the Finance. Now, which Finance Act is applicable? Why did I say you have Finance Act 2023 applicable? For your examination, which previous year we are looking at? For your exam, which previous year we are looking at? Yes, Anju will upload the notes after the class, but you have to keep on writing and not look from the notes. Yes, which Finance Act and which previous year we are looking at for your exam? Yes, students. Yes, Viraj, we are looking at assessment year 24-25 and previous year 23-24. So for your examination, the previous year is going to be 23-24 and the assessment year that we are looking at is 24-25. So which Finance Act, why Finance Act 23 is applicable and why not Finance Act 24 is applicable for your exam? No, Shravanan, 22-23 is not, it's 23-24 for your examination. Yes, Geeta, that's correct. But Ravish, previous year 22-23, no, it's 23-24 financial year which is applicable or the previous year which is applicable for your examination. We are going to have previous year 23-24, Ravish, and not 22-23. Yes, Shankara, correct. Yes, Chitala, it's previous year 23-24. But why Finance Act 2023 and why not Finance Act 2024? Yes, yes, students, fast. Yes, fast students. Applicable from 1st April 24, bill approved in 23, Mithalia, no. Because Finance Act 23 is for previous year 2024, no. Yes, Vinay, Finance Act 24 is yet to come, but it will come before 31st March itself. Finance Act 23 is for current financial year, no. Nobody is giving me the right answer. I'll tell you the reason why. So, for the each year, if you look at the timelines, when the Finance Act gets passed. So, the Finance Act, usually the union budget comes on 1st of February, isn't it? The union budget comes on 1st of February. Then it goes to Lok Sabha and it becomes the bill, finance bill. When it goes to the Lok Sabha, it becomes the finance bill. Once it becomes the finance bill, it gets passed by Lok Sabha, then it goes to Rajya Sabha, and finally it will go to the, if it is passed by both the houses, then it will go to the president for his assent. And once the president will give the assent, then the bill becomes the act. Bill becomes the act, right? Now understand one thing very, very clearly. Under the Income Tax Act itself, under the Income Tax Act itself, there is a section which says that the law as on the 1st April, the law which is standing as on the 1st April will be valid law or will be considered basically. So, what this section says is, there's section 294 of the Income Tax Act. It is saying that if the law is there, which is existing as on the 1st April in any assessment year. So, the law which is standing as on the first day of April in any assessment year, that law will be applicable. Now, the Finance Act 2024 will get passed by 31st of March 2024. So, that will be a law which will be standing as on 1st April 2024. So, my question is, why not Finance Act 2024 is applicable to you? The reason is that if you go to the Finance Act, in the Finance Act, there are three parts. In the Finance Act, there are basically three parts. The part one which is there, in the schedule, there's a first schedule to the Finance Act. In that, the first part which is there, part one which is there of the first schedule to the Finance Act, it specifies the rate of tax which is applicable to the current assessment year. So this will provide for the tax rate for current assessment year, which is going to be, which assessment year we are talking about? '24, '25. Sorry, 23, '24. This will talk about the current assessment year, Finance Act 23 we are looking at. So this will talk about the current assessment year. The part 2 which is there will give you the TDS rates. Will give you the TDS rates for the previous year 23-24. So part 1 to the schedule 1 will give you the tax rate for the assessment year 23-24. Part 2 will give you the TDS rate for the previous year 23-24. And then we have part 3 which will give you the tax rates for the previous year 23-24 for the purpose of advance tax and the basically TDS. So if you look at it, if Finance Act, instead of 23, we have Finance Act 2024, then what will happen? The first part will give the tax rates for 24-25 or the AY 24-25. Now, what happens? Every year, this part 3 automatically becomes part 1. So this would have been part 3 of Finance Act 2022, which will become part 1 of Finance Act 2023. This year, part 3 will become part 1 of Finance Act 2024. Are we getting that? So essentially, even if the Finance Act 2024 will become applicable, that is being applicable from the next 1st April. So what we have to look at is, as on the 1st April 2024, which is the assessment year, which Finance Act was applicable to me? That is Finance Act 2020. Because as on 1st April 2024, which is the assessment year, the Finance Act applicable to me is this. Even if I say this Finance Act 2024 is applicable, the first part will be applicable, which will have the tax rate of the earlier Finance Act. Are we getting that? So the law which is standing as on the 1st April of that previous year will be the law which is applicable to me, which is the Finance Act 2023 at the moment. Clear? Any questions? Any doubt? Ravish, for your examination, the cutoff date is 30th September, but we have to look at the Income Tax Act itself, for which the cutoff date is not 30th September. Clear? Shall we take a break over here? Okay, let's take a small break of 10 minutes and then we get back. Okay. Yes, Ramakrishnan, the class has started because confused between part 3 and part 1. As I said, the part 3 is for the previous year, which is the current previous year, which is 23-24, and the part 1 is basically for the last previous year. So basically, that is for the assessment year, current assessment year. So part 3 will become part 1 again of the next Finance Act. Okay? Yes. So let's proceed forward then. So total income of a person into tax rate will give you the income tax. So which is what the charging section is telling you here. Fine. This is your income tax. Okay. Now, total income of a person. As I said, we have understood what is the definition of person. Now, the income of the previous year is charged to tax in the next following assessment year. So, I will have the income of the previous year, total income that I have earned till 31st of March 2023 will be charged or will be assessed to tax in the next following year. Right? Now, understand one thing. There is an exception to that as well. There is an exception to that particular term as well. So when I say that total income of a previous year is charged to tax in the next following assessment year, there are certain exceptions to that particular term as well. So to that particular rule as well. And what is the exception? That the total income of the previous year may be charged to the tax in the same previous year only and not in the assessment year. And not in the assessment year. So what are the exceptions? We'll see. So the general rule is total income of the previous year is charged or assessed to tax in the assessment year. The exceptions to that are number one exception. The shipping business of the non-resident. The shipping business of non-resident under section 172. So what happens is the non-resident seafarers which are there, or the not seafarers, the non-resident shipping companies which are there, they would come and bring certain goods, or maybe sometimes the passengers as well, which they generally carry from one country to another country. So there are ships running which are bringing the goods to the port in India. Now, usually once these ships will leave, there's no guarantee that they would pay the tax in the assessment year. So they would be, of course, earning the income either through the passengers of India, or they would be earning the income, let's say, through the carriage of the goods which is happening through and from India. So once they leave Indian port, there is no guarantee and there is no way to catch them and ask them to pay the taxes in India, right? Because ultimately these are non-resident companies. So therefore, section 172 requires that the ship will be allowed to leave the port only when the taxes will be paid or the arrangement for the payment of taxes being made. We learned about section 172 in the PGBP, presumptive taxation, where we make a comparison between section 44BB versus section 172. But 172 requires that the tax has to be discharged before leaving the port in India by the ship or by the shipping company. So therefore, which means that the income of the previous year is charged to tax in that particular previous year itself. So in case of shipping business of a non-resident under section 172, the tax will be charged before the ship leaves the Indian port. Before the So there is a clearance certificate, tax clearance certificate, which is granted to such companies. Unless they have the tax clearance certificate, they are not allowed to leave the Indian port. Second one is the persons leaving India. Persons leaving India. So sometimes there could be certain individuals which may, leave India in order to avoid taxes, and they would not have any intention to come back. So many examples, right? We are all aware about them. We will not take any name, but we know the examples where people have just flew from India, taken the escape, and just never returned back to India. So the AO has the authority if he believes, if it appears to the AO that an individual may leave India and he may not have any intention of returning back. So in that case, the total income of that particular individual up to the date of his departure will be charged to tax in the previous year itself. So this is basically the power which is given to the AO. If it appears to the AO that the individual may just escape from India, so before he could leave India, the income tax officer can ask the particular individual to pay the income tax on the income which is earned up to the date of his departure from India. Are we clear? Or any person which is likely to transfer the property to avoid tax. Person likely to transfer property to avoid the tax. So it is possible that the people may just sell off their assets to avoid payment of liability. Because if, let's say, for example, if I have a tax demand notice under 156, under section 156, the notice of tax demand is issued. Now, if I don't pay the demand within the stipulated period, there can be attachment of my personal property, right? And once the income tax officer will attach the property to recover the tax demand, what will happen is they will sell off that particular property to repay the tax demand. In order to avoid that, the people may sell off their assets to avoid the payment of, because then they will say we don't have any property. Then they will say we don't have any property. How can you attach then? Because it is sold. It is now belonging to somebody else. So therefore, if it appears to the AO, again the power is given to the AO, that a person is likely to sell or transfer any of his assets to avoid the payment of any tax liability, the total income of that particular person, right, will be charged to the tax in that particular previous year itself. Let's say, for example, if there is some defaulter who is likely to sell his, let's say, some house properties which he has with a view to avoid the payment of income tax. Such a case, the income tax officer up to that date, till the assessing officer thinks that, okay, this person is likely to sell. So up to that date, when the income tax officer gets that particular information that he is likely to sell, up to that date, they can charge and collect the tax in the same year itself. Similarly, let's say, for example, if the AOP or BOI, these are generally formed for specific purpose. The AOP or BOIs which are there are formed for a particular purpose, right? So the people come together, the individuals come together and form BOI, or the different type of persons come together to form association of person for specific purpose only, right? They may have certain contract that they would have received, so they would form AOP, finish up that contract, and it's done. So it is quite possible that the AOP or BOI will get dissolved once that purpose is achieved. or once that particular event occurs. In that case also, the income tax officer, if he believes that the AOP will get dissolved in that year and then he may not be able to make assessment, he can make the assessment up to the date of dissolution. Up to the date of dissolution. Right? And that particular income tax will be collected in the same. Last one is, last exception. So there are 5 exceptions. Last one is discontinued business. Discontinued business. Where any business or profession is discontinued in the particular assessment year, the income up to the date of such discontinuance will be charged to tax in that particular assessment year itself. If the income tax officer is of the opinion that they may not pay the taxes subsequently, so he can collect the tax in the same year. If the income tax officer wants, he can wait till the completion of the assessment year. He can wait till 31st of March and collect the taxes in the next year. Alternatively, he can collect the tax in the same year. So these are the 5 exceptions which are there. Ramakrishna, the officer will get the information because they keep track of such evaders, because see, it's not that the case that they would, not get this information, because these kind of assessments are made on high evaders, high tax evaders generally. So they try to keep a track of them. And then they inform the passport officers, the visa authorities that these are the tax evaders basically, and they are in that radar of the income tax authority. So when they usually get to the immigration zones, the income tax officers usually come to know about it. Okay. Yes, any doubt? Okay. So these are basically the exceptions to the rule of income of the previous year. Total income of the previous year is charged or assessed to tax in the next A1. Fine. Okay. So again, going back to the same thing, total income of a person. As I said, person is defined under 231, which includes the individual, HUF, AOP, BOI, firm, company, and local authority. Now we'll discuss one by one because these are some of the definitions that you should be knowing, and therefore we have the discussion now around the definition part. Now, as I said, individual, all of us know who is an individual. Individual could be male, female, senior citizen. So that will be constituted in the individual, right? Then we have Hindu undivided family. So Hindu undivided family is governed by the then Mitakshara, Dayavaga law, all of that you would have studied, right? So that is the Hindu undivided family basically. So Hindu undivided family is again a separate person. It is governed by the Hindu Succession Act, which is there, right? And they have the Karta and the co-partners basically. And again, the taxability for the same we will discuss separately in the assessment of the various entity class. So Hindu undivided family will include the Karta, the co-partner, which would have the male and the wives and daughters, all of them. Then we have the firm. So the firm means the partnership firm, right? Which is as per the Indian Partnership Act. It will also include the limited liability partnership under the LLP Act. Right? So the firm which is there is as per the Indian Partnership Act. The firm will also include the limited liability partnership. Are we clear? Now, then comes the company. Now, this is very, very important. So, the definitions of all of this is given. Individual, of course, is not defined. But then we have the definition of the firm which is there present in the section 2 itself. So, if you look at section 2, it defines the firm, which means that the meaning assigned to it in the Indian Partnership Act, and it will also include the limited liability partnership. And if you go to the Indian Partnership Act, you have already studied in CPT that a partnership is basically a relation between the persons who have agreed to share the profits of business, and they have collectively come together to form that partnership. Then again, the company is also defined under the section 2 itself. Now, how is the company defined in the section 2? So, company is categorized into different types of company. So, let's write it down for the company, because this is going to be important for determining the tax rates. This is defined under section 217. This means company means Indian company. Now, what do we mean by the Indian company? Again, Indian company is defined. Indian company means company formed and registered. Company formed and registered under Companies Act 1030 or 1956 of the earlier. So this is defined under 226. So Indian company means a company formed and registered under the Indian Companies Law. Right? It also means a foreign company. It also includes a foreign company. Right? It also includes a foreign company or a body corporate incorporated outside the laws of India. Now, what is a foreign company? What is a foreign company? Again, the foreign company is defined under 223A. Foreign company is defined to mean a company which is not a domestic company. Foreign company is a company which is not a domestic company. So now, what is the foreign company means? A company which is not a domestic company. Now, what do we mean by a domestic company in that case? What do we understand by the term domestic company? Now, domestic company is again defined. Domestic company is again defined. Does it mean that it's a domestic company? Does it mean that it means the resident company? Answer is no. A resident company is separate. A resident company is separate. A domestic company is separate. Domestic company is defined under section 222A. Domestic company is defined under 222A. So how is it defined? I'm just putting it aside. So domestic company means a company which is an Indian company. So domestic company again refers back to the Indian company, which means an Indian company as defined in the 222(6), which means a company registered and incorporated as per the Companies Act. Secondly, it can also include a foreign company. A domestic company can also include a foreign company which has made the prescribed arrangement, for the declaration and payment of dividends in India out of its income taxable in India. So it also includes a company which has made arrangements for declaration and payment of dividend within India out of its taxable income. So means any foreign company, which means any foreign company can be considered as the domestic company if that foreign company has made the arrangements for the declaration and payment of dividend within India out of its taxable income. So a domestic company not only means that it is an only Indian company. Domestic company is different also from a resident company. Domestic company is different from resident company. Domestic company means that it is a company which is an Indian company. It can also include a foreign company if the foreign company has made the arrangement for the declaration or payment of dividend within India out of its taxable income. Now, what do we understand by the term? What do we understand by the term? Make the arrangements for the declaration and payment of dividend within India. What do we understand by that? So, the rules are given to that effect. So, Rule 27 of the income tax rules provide that the foreign company which is there, it will be considered that it has made the arrangement for the payment and declaration of the dividend here in India based on the satisfaction of the following condition. So how would you know that a company has made the arrangement for the declaration of the dividends here in India? How would you know that? Right? So we get to know based on Rule 27 that if the share register of the company is maintained at the principal place of business within India, if the share register of the company is maintained here at the principal place of business in India, or if the general meeting for passing the accounts and for declaration of any dividend is held at any place in India, or if the dividends which are declared are payable in India to the shareholders, then it will mean that that company has made the arrangements for the declaration and payment of dividend in India. And then that company can be treated as a domestic company even though it will be a foreign company. So which company is a foreign company? One which has not made the arrangements for the declaration and payment of dividend in India means it's not a domestic company and that company will be a foreign company. Are we getting that? Then there could be a resident company. So what do we understand by a resident company? Which company is a resident company? If again it's an Indian company, an Indian company will always be a resident in India. Secondly, a foreign company having place of effective management in India. Foreign company having place of effective management in India. This is defined in section 6. Otherwise, the company will be a non-resident. A foreign company not having a POEM in India will be a non-resident. Now, why do we have a domestic company and a resident company? Why do we have a resident company and a domestic company? Why do we have those categories? So understand one thing very carefully. So the domestic company that is there, that is important to determine the tax rate. The tax rate determination Tax rate determination is not based on whether a company is a resident company or not. The tax rate determination is based on whether a company is domestic company or foreign company. So for determining the tax rate, the company, whether it is a domestic or a foreign company, that is to be determined. Even if a company becomes a resident company, the tax rate, let's say there's a foreign company which has a poem in India, it will become resident. So then the tax rate will not be that of a domestic company. The tax rate will continue to be applicable of the foreign company. The tax rate which will be applicable to that company will be that of the foreign company. So whether or not a company is a domestic company, that will help you determining the tax rate. So even if I am a foreign company having the poem in India, I will become a resident company. A foreign company having the board meetings in India will have the poem in India. We'll learn about the poem concept in the future classes, but that company will become a resident company. Now, once it becomes a resident company, will the tax rate be of that the Indian company? No. The tax rate of that particular foreign company will be as per the foreign company tax rate and not as per the domestic company tax rate. Because that foreign company is not becoming a domestic company, it is becoming a resident company. That's why I said there is a difference between domestic company and a resident company. Do not get confused. For determining the tax rate, you need to see whether a company is a domestic company or a foreign company. A foreign company can also be a domestic company, provided it has made the arrangements for the payment and declaration of dividend in India, or for the declaration and payment of dividend in India. But just because a foreign company has a poem in India, that company will not become domestic company. You can write down in red over here. Foreign company having poem in India will become a resident company, but not a domestic company. But not a domestic company. Therefore, the tax rate of foreign company will continue to be 40%. Foreign company tax rate is 40%. Domestic company, we have 30%. So for the tax rate determination, you need to identify whether a company is a domestic company or a foreign company. For the scope of total income, determination, you need to just determine whether a company is a resident or a non-resident. So scope of total meaning, if a company is a resident, global income will be taxable. If a company is a non-resident, only the income which is accruing, arising, deemed to accrue or arise in India or is received in India, only that will be taxable. So if a company is resident, my global income is taxable. If a company is non-resident, then only income accruing or arising or deemed to accrue or arise or received in India is going to be taxed. This is section 5 of the Income Tax Act. What does section 5 says? If a company is a resident, global income will be taxed. If a company is a non-resident, only the Indian sourced income plus income received in India will be taxable. So therefore, for determining the scope of total income, you don't need to decide whether a company is a domestic or foreign. What you need to determine is whether the company is resident or a non-resident. And when will be a company resident? When it's an Indian company or if the foreign company has the place of effective management in India. Are we getting this? So, in the exam, these words may be used. You don't have to get confused. Right? You don't need to get confused with these terms. Then there is one more type of company, which is widely held company and closely held company. Now, what is a closely held company? Company in which public is not substantially interested. Company in which the public is not substantially interested. Again, that is defined. A closely held company and a widely held company is defined. So Section 2 of the Income Tax Act defines a company in which public is substantially interested. Meaning a company in which public is not substantially interested will be a closely held company. So Section 218 of the Income Tax Act defines a company in which the public is substantially interested. So, company in which public is substantially interested. And which is this type of company? So, 218 says that a company is said to be a company in which public is substantially interested. 218. Where if it is a company owned by government or by the RBI. If it is a government company or RBI owned. Government company or RBI owned. Or a not-profit organization or a non-profit organization, which is a Section 25 company basically. Section 25 company. So Section 25 company, all of us know, or Section 8 company of Companies Act 2013. Now it is Section 8. Earlier it was Section 25 company under 1956. You can write here Section 8 company. Section 8 company. Then it could be a mutual benefit finance company. A mutual benefit finance company. A company where more than 50% is held by the cooperative societies. A company in which more than 50% is held by the cooperative societies. Or it should not be a private company. A private company is not a company which is the company in which public is substantially interested. Right? So private company, which is what? Private company is basically the private company as defined under the Companies Act. Private company is the company which is defined under the Companies Act as the private company. So it should not be a private company basically. So a Section 8 company, then owned by cooperative society greater than 50%. Nidhi company, and it can be a listed company. A listed company is a company in which public is substantially interested. Listed company is the one in which the public is substantially interested, which is listed on the recognized stock exchange in India. The shares of the company are listed in the recognized stock exchange in India. Or a private company one second, let me just move this down. A private company which is subsidiary of listed company. A private company which is subsidiary of a listed company will also be considered as a company which is a widely held company. Right? So, a private company whose shares are held by the listed company. So, basically, a private company which is subsidiary of the listed company. In that particular case, or which is held by a government, in that particular case, the company will be considered as the widely held company. Clear? So that means closely held company is one which is a private company basically. Private company or the unlisted company, private company or unlisted company, here also can I, which is not subsidiary of listed company. That will be a closely held company. Now, why is it important to determine a widely held company and closely held company? Because there are certain provisions which are applicable to a closely held company, because closely held company are susceptible to tax avoidances because of the small group of shareholders. So certain anti-abuse provisions are applicable only to closely held company and not to widely held company. Example, deemed dividend under section 222E is applicable only to a closely held company, or section 56 to 7B, which is angel tax provision, which we are going to see later, are applicable to closely held company. Okay. So for that purpose, we need to determine what is a closely held or a widely held company. Are you clear up till this? Yes or no? Yes. A lot of basic concepts that we have studied today. You have to revise it when you sleep. Before you sleep. So these concepts should not make you sleep. Rather, they should make you awake that, okay, these are so many complex provisions that we have to remember. And these small points can be part of your question. So you have to be very careful. And if you're clear with the concept, as I said, only then you will be able to attempt properly your examination. Because somewhere, a smaller line will be put up that, okay, this is a domestic company. Or somewhere a line will be put up that this is a closely held company in the introduction of the question. So you should be aware about these particular points. Right? You should be aware about these particular points in detail. Clear? Okay. So we have seen then the definition of individual, not the definition of individual, definition of the firm, then definition of the company. Then what is AOP? AOP is association of person. BOI is the individuals coming together. AOP can include even a company, a firm, because it says person, who are basically coming together for a common purpose or for the common venture. So they are coming together to share the income jointly and to put the common efforts to earn the income. So they could include the HUF, the AOP can include the firm, it can include even individual. And if there are only individual, it will be BOI. So there's a difference between BOI and EOP. Fine. So total income, we saw total income is defined in the 245, which says the total amount of income computed as per the provisions of the Act. Total amount of income as referred to in section 5. Section 5 talks about the scope of total income computed as per the provisions of the Act. And total income of a person for a previous year is charged to tax at the rates which are specified either in the Income Tax Act or under the Finance Act in the next assessment year. Clear? Now, what do we understand by the total income? The total amount of income. Income is defined under 224. Now, before we close the session, we also need to understand 224. I'm not going to go into the detail what kind of incomes are written in 224. It's very, very wide definition. But what we have to understand over here is the concept of revenue income versus the capital income. Now understand one thing very, very carefully. Whether capital incomes are chargeable to tax, the answer is no. So the capital receipts, not capital income, the capital receipts are not chargeable to tax. So there could be a capital receipt versus the revenue receipt. Before this decade or maybe, 2 decades back, when we talk about most of the litigation used to be around capital versus revenue receipt. Today, there are so many decisions that it has, because of the interpretation, the guidelines given in those decisions, it has become much clearer that what do we understand by capital receipt versus revenue receipt. But even today, there are many cases which are happening around the classification of receipt, whether it's a capital or a revenue receipt. Why? Because if it is a capital receipt, the capital receipt will not be charged to tax unless specifically provided for. For example, the gifts. When you receive the gift, it is a capital receipt. Capital receipt is something which I do not get it out of my activity, which I'm doing it on day-to-day basis for the livelihood, which is one of a kind. That is a capital receipt basically, right? So the capital receipts which are there, they are not earned in the ordinary course of my business. They are not the regular receipt. They are the casual receipts mostly. Right? So that will not be taxed or that will not be considered as income unless specifically provided for. Right? So capital receipts cannot be taxed unless they fall within the scope of the definition of the income. As I said, gift. Gift is a capital receipt. Do you receive the gifts daily? Answer is no. But we have the taxability of the gift under 56(2)(10). And that is included in the definition of income. That is included in the definition of income, that if you receive any sum of money or any property without consideration or for inadequate consideration, that will be considered as your income. So even though it is a capital receipt that has been specifically made chargeable to tax. So capital receipt is something where it is something which is coming out of my fixed capital. It could be a capital gain. By selling the assets, I do not sell the asset. It's not my activity to sell the assets. If my activity is to, sell the property, I'm a builder, I'm a real estate owner, a real estate developer. So then it will be my stock in trade and not a capital asset. Then it will be my revenue receipt. But if I'm selling the capital assets, the capital gains. Now, capital gains are specifically included in the definition of income. So, unless it is specifically included, the capital receipt cannot be charged to tax. If I'm doing, the sale purchase of the shares and securities, I'm an investor, so it's a capital gain. Versus if you do it as a trader, it's a stock in trade and therefore it will be considered as your business income. So let's say, for example, if let's say my contract gets terminated with the company, I'm an employee of a company, they terminate my contract and they say that from tomorrow onwards you do not come, but they are paying me compensation. They are paying me the compensation for asking me to leave the employment. So the compensation which is received from the employer for termination of the contract is a capital receipt. But it is taxable under section 17(3) specifically as profit in lieu of salary. As profit in lieu of salary. So that is specifically chargeable to tax as income. Similarly, there is contract of agency. If you terminate it, you have to pay the compensation. Let's say, for example, non-compete fee. I'm paying you the non-compete fee to not compete in my business. That is again a capital receipt, but these are specifically charged to the income tax. If you look at 28(2) for compensation for termination of agency, if you look at 28(5)(a) for the non-compete fee, these are specifically made chargeable. So capital receipt, unless chargeable to tax, will not be considered as the income. On the similar line, let's say for example, if I have purchased a machinery. Let's say for example, if I have purchased a machinery from a supplier. Now, let's say for example, this machinery never reaches to me. This machinery never reaches to me. Why? Because let's say for example, either there is the damage of the machinery which happens in the transit because of the lack of vigilance taken by the supplier. Now, in that case, the supplier gives me the compensation, whether it is a capital receipt or whether it is the revenue receipt. Because the closely held and widely held company, you can find it in the assessment of various entities chapter, but because it's linked, I have taken it over here. Yes. So, if I have received the compensation for the damage of machinery which was in transit, whether it is a revenue receipt or a capital receipt. If it is a capital receipt, why do you think it's a capital? If it's revenue, why do you think it's revenue? Yes, Ravish. Yes, Vanshika. Capital receipt. But why? Yes. Why do you think it's a capital receipt? Shravanan, why do you think it's a capital receipt? Ravish, since it was in lieu of a capital asset, okay, possible. Yes, any other answer? See, this is very, very important to determine whether it's a capital receipt or whether it is a revenue receipt. Yes, Vanshika, because it is not ordinarily happening event. That's correct. Not a regular business, Shravanand. Yes. One of a kind. Yes, Shravanand. Okay. So all of your answers are correct. So understand this thing that if I receive something which is for the sterilization of my profit making apparatus, which is for the sterilization of the profit making apparatus, or which is the compensation for sterilization of the profit making apparatus. So, ma'am, what terms are you using? It's going beyond that. So, compensation or liquidated damages, which are paid for sterilization of profit making apparatus or source. What do we understand by the sterilization of the profit making apparatus or source? So if the compensation which I am receiving is because of the damage that has caused, the damages for the failure to supply the machinery within the stipulated time by the supplier has resulted into the damage for me in procuring the capital asset, which led to delay in me earning the profits. So basically it led to delay in coming into existence of the profit making apparatus. So the plant which was there, the machinery which was there, which I was purchasing, was basically to use it for my business. And by using that machinery, I would have generated profits. Right? Any asset that we purchase is with the intention to generate the profits for a long future time. That's why it is classified as asset, basic accounting. So any asset is what? It's a profit making apparatus. Any asset is a profit making apparatus. So the damages which are paid are linked with the profit making apparatus. It was not a receipt in the course of earning the profit. It was not a receipt in the course of earning the profit. The amount which was received as a compensation because my profit making apparatus got sterilized, got halted. So therefore, it is not in the ordinary course of business. It is a capital receipt. So you can write down compensation or liquidated damages paid for sterilization of profit making apparatus or source is linked with the procurement of capital asset or profit making apparatus, is linked with the procurement of capital asset or profit making apparatus and is not in ordinary course of business. Therefore, it would be capital receipt. Clear? Saurashtra Cement Limited. Supreme Court ruling. Saurashtra Cement Limited Supreme Court ruling. Now, this can come not as a part of case law, but this can be an adjustment to your question, to your total income question. The assessee has received the liquidated damages for delay in supply of machinery. What will be the adjustment? Write it down over here. This could be the adjustment in exam. Assessee has received liquidated damages for delay in supply of machinery. The amount is included in the net profit. The amount is included in the profit and loss which is given. What will you do? You will reduce from the income or reduce from the profit which is reported to you, and you will write the reason in the notes. You will not write the reason over there. You will reduce from your net profit and you will make a reference, refer note number so and so. And you will write that this is a compensation which is paid for the sterilization of profit-making apparatus. This is not in the ordinary course of business and therefore it will be the capital receipt and not a revenue receipt. This is also in line with the principles laid down by the Honorable Supreme Court in Saurashtra Cement Limited. So this is how you're going to write. Thank you, Vikas. So this is how you will write for your exam. Are we getting that? There's one more important judgment on this point. You have to remember the name of this judgment. So please, let's mark this as yellow. This is very important and very often asked adjustment. So all the students who are here attending the lecture should not forget about the Saurashtra Cement Limited case. Fine. There's one more judgment which is a very recent judgment which is there. These are also present in your module, right? So you can go through. Whether in a case where, Honda CL, Honda cars basically, right? Now, Honda had paid a technical fee for improving its business, because it's a car manufacturing company. So they are always into innovation of bringing new cars. Otherwise, you see like a lot of competition. You have so many competitors which are there. And these days, if you look at Honda, they are not coming up with new car models also, right? So they are always innovating so that they can bring new model, right? So therefore, they paid some technical fee under a technical collaboration agreement because they wanted to set up a joint venture company in India. So they had entered into a technical agreement, a collaboration agreement with a foreign company so that they can set up a joint venture in India. And what was the purpose of that agreement was that the foreign partner will transfer the technical information, will help them establishing the plant here in India so that they can start with a manufacturing unit. Now, in that contract, under that contract, they paid a technical fee. So a technical fee was paid to the joint venture partner under a technical collaboration agreement for setting up a joint venture in India. Now, whether this technical fee is a capital receipt or a revenue receipt, whether it is a capital receipt or revenue receipt. So what do you think? Yes, yes. Why, Ravish, you think it's a capital receipt? Vanshika, you think it's a one time, that's why it's a capital receipt? Yes. Others also need to answer. You don't need to leave the lecture in middle, okay? Even if like last 5 minutes are remaining, you have to stick around because the one who is there till the last laps, that person will, be counted as a winner. It's not important that how much you were present throughout because sometimes I may say something very important in the last 2, 3 minutes. So you have to be present. Yes, yes, fast. I know you are hungry, all of you. Okay, let me tell you. So, again, this is a Supreme Court ruling in Honda CL. What was held in this ruling? That the technical fee paid in as per the technical collaboration agreement. The technical fee paid under the technical collaboration agreement, which is there, was basically to start the manufacturing operation. Was to start the manufacturing operation or to improve the existing business. Sorry, was to start a new manufacturing operation or was to start a new business. Was to start new business. Was to start a new business or new manufacturing unit. If this technical fee was not paid, then the agreement would have not taken place, and therefore, what will happen? I would have not been able to start a new business. Therefore, this is a capital receipt. This is a capital receipt. Of course, if I pay the fee, if technical fee is paid for existing business, this may be revenue receipt. This is to start a new business altogether, a new manufacturing unit altogether. And that is why this is a capital receipt. So It's not just because it's a one-time fee. We can pay one-time fee and it can still be a revenue one. What is important is that for what purpose I'm paying, I'm bringing in a new source of income. And therefore, it is a capital in nature. Clear? Yes, Vikas, you need to give the case law reference in the questions which are asked, and therefore it is essential to remember the name of the cases. Like, let's say, for example, this Honda CL, I would not say it's very, very essential to remember, but yes, Saurashtra Cement, it is. So I'll keep on telling you as to which cases are very important, and you have to remember this because these are often asked in the examination. Okay. Okay. So what I need from you is now we have done the basic concepts. You will go through the module. You will go through the entire module of basic concepts. So basic concepts in entirety for today's class, for the next lecture also. In the next lecture, we are going to discuss about the tax rate. I have not even touched upon tax rate. What we have spoken here was about the total income, about the different definitions. So you will go through this particular stuff before you sleep tonight. Tomorrow you will study from module. And day after we are again meeting where we will be discussing about the tax rates. And we'll solve a couple of few questions. Clear? So you're required to go through that in entirety. Are you with me? Yes. Before we close the session, you're going to do that. No lapses. Absolutely no lapses because see, you have to be true to yourself. I'm not going to ask you in the next class or neither you are going to be answerable to me whether you did study or not. But you have to remain absolutely true to yourself and you have to make that extra effort to get these two letters besides your name. Okay? Yes. Thank you so much and we'll meet in the next class. Okay. We can close the session.